Hello and welcome to this episode of the Australian Finance Podcast. In today's episode, we're going to be flashing from here in Melbourne to Sydney, where we recorded with Cameron Gleeson, one of the senior team members at Betashares, and we talk about defined income. Now, you're probably thinking, defined income, what does that mean? Well, it's got income and it's defined. It sounds pretty good if we can define what that means in this episode. You're going to hear about quite an unusual series of ETFs. If you're interested in income, if you're thinking, how can ETFs be used to kind of consistently generate good income, passive income for me, this is the episode for you. I hope you enjoyed this episode of the Australian Finance Podcast, talking about all things income with Cameron Gleeson of Betashares ETFs. Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Cameron, it's good to see you.
Good to see you, huh?
Today we're talking about income certainty and something called defined income. Mm-hmm. We're also talking about bonds. Now, you and I are recording this here in Sydney. We've got a beautiful outlook here over the Sydney Harbour area. And we just come off talking about currency hedging, you and I, which is probably the other most technical part of ETF investing. Now we're going into bonds. But for people that are interested in income, I think this episode is going to be for you. And that's pretty much everyone. But in particular, people with term deposits, savings accounts, retirees looking for some type of consistent monthly income from their portfolio, this is the episode for you. So my first question to set the framework for what we're about to fill in is, currently, you brought up the numbers, the Reserve Bank of Australia at the time of recording, interest rates are over, say, 4%. If I had a 10-year view, I'm looking at, I want income that's good for the next 10 years. Is it reliable to, is it safe to assume that I can get that 4 to 5% over that long period of time?
It depends on what you're looking to invest. If we're talking about, investing in a cash account or holding a term deposit, what the market's telling us is that the RBA is going to cut this year. And I don't know when we'll go to air, but right now there's a cut fully priced in for this month, which we're in early May.
Yep.
And the expectation is that the RBA's cash rate will fall from 4.1 and will be 3% in a year's time. And so right now you can go and get an online saver account or even a very short-term term deposit, and you can earn, with bonus interest rates over 4%. And that's been great. Like, it's been a really good thing for investors in Australia that we've had this higher interest rate environment and they've been able to do that. But what we actually saw since around about August last year is that term deposit rates for periods of, for example, 3 years started to fall. And that's because banks, when they are providing interest rates for term deposits, they are looking forward and they're looking to see what they think the RBA is going to do. And you're fixing an interest rate, right? They want to make sure that they're pricing in the probability of the cash rate falling. And so, looking forward, the major banks and Macquarie, it's sort of difficult to get a 3-year term deposit paying monthly, which has a yield, or an interest rate much above, 3.1%. It's
which is a big way down.
It's gonna, we should expect that it will fall. Now, that's a good thing. The reason why it's obviously falling is that inflationary pressures are coming down, and that's a good thing for the economy. But if you're a saver and you're looking to hold money in defensive, very low risk assets, it means that term deposits weren't what they once were, unfortunately.
Yeah, which is a lot of people right now. And that probably leads to the second question, is that I remember a few years ago, not that long ago, when people seemed to be taking a lot of risk with either their investments or stuff that they would have in cash. They might have gone and put in crypto or in property that they might not otherwise have done, because they were like, well, where can I get some return? Over the recent few years, interest rates have been 4% plus, maybe 5% for some bank accounts and those types of things. Do you think investors' behavior has changed recently?
Look, I think it has. I mean, we certainly saw an increase, and actually we saw a real increase in terms of fixed income ETFs because they've been yielding, great rates of return. But more recently, in terms of term deposits, we have actually sort of seen, a bit of a decline in interest or people looking for alternatives to term deposits because those rates, if you look out beyond 1 year, have fallen below what the current cash rate is. And people are starting to say, well, what can I get elsewhere? Can I earn more than sort of 3% with my money? Maybe I should expect to do that given where cash rates are today. So people are looking for alternatives because it's important. Inflation is still sort of around about 3%. I want to be able to beat that even with my cash, right? If I'm not beating inflation, I'm going backwards.
Yeah.
So I need to find some way to do that.
Yeah, it's been really, really interesting to see how in recent times, like 2025. People have all of a sudden started to pay attention to bonds again. And this whole part of the universe, like, oh, I still want this good income. Where am I going to go now kind of thing? Because some people are starting to realize. So let's start with a very basic question, a question that even like finance people struggle to translate to other people in their, maybe their friends or family. In the simplest possible way, Cameron, can you explain what a bond is?
Yeah, that's a great question. I mean, I think the simplest way to describe a bond, it's like a loan. I think that's the easiest way to describe it, really is. So if you think about a bond issued by, say, BHP, it's a loan where BHP is borrowing money from the bond holder. They're the bond issuer, they're the borrower, and you as the bond investor, you're lending the money. And obviously, if you are lending money, you expect to receive interest along the way, and you expect to receive the loan face value or the principal back at maturity. Now, there's different types of bonds, different types of interest rates on bonds, and different features. But broadly speaking, I think we would characterize a bond like a loan. And where bonds can be useful as an investor is that, when you're lending to, say, a corporate or even a government, they allow you potentially the ability to earn more than you might earn in a bank account.
So these often sit, if we zoom out a bit, these often sit at the defensive end of someone's portfolio.
That's right, yeah.
They're typically lumped in with the cash and a few other things, but they're defensive. And these have like centuries, I'm guessing, of history of like loans being given. And we probably only named them bonds, who knows when. But I often think of the phrase, my word is my bond. It's kind of like a promise.
Yeah.
And I just think that one of the big other things that people should be aware of in a traditional sense is that bonds can also move up and down a little bit, kind of like shares, but not to as much of an extent, depending on what we're talking about. Another feature is that unlike a savings account, they have a little bit more risk because they can move up and down. So we should make that distinction.
Yes.
But a lot of people who listen to the show will say things like, well, why would I use bonds? Shares have done so well.
Yep. Yeah.
So what do we say to something like that?
Yeah, look, I mean, shares have done well. But if we look at, say, for example, the yield on the ASX, including franking, we may see a yield of around about sort of 4.1% this year. I think that might be what's forecast. And what bonds allow you to do, they allow you to earn more than cash. And they also allow you to earn more income than shares now, like, depending on what part of the bond market you want to invest in. And that's important. That's powerful, being able to provide exposures that are less risky than shares, giving you more income than shares. And it hasn't always been the case. We've obviously come off a very low rate environment, but we still see that there's really good income potential from bonds, as well as, depending on the types of bonds you use, the ability to diversify your risk. When we talk about building a multi-asset portfolio, diversification is key, and bonds can actually provide a degree of offset where they can actually appreciate when equities fall in something like a recession. So there's multiple reasons to use bonds, and there's multiple types of bonds. So it's a very wide market, and it's worth pointing out that the global bond market is actually much bigger than the global share market or global equity market. So it's a very big, important part of the financial system.
I'm going to try ask you for something off the top of your head, Cameron, which is, what would you say is the most popular Betashares bond or fixed income fund?
So, I mean, out of that, I'd say AAA, which is actually a cash ETF. We would consider it in the bond and fixed income suite. So this is a fund that's I believe it's 5.5 billion in assets under management.
Wow.
And it simply holds cash across a range of bank accounts. And it's since inception, which is more than 10 years, yielded more than the RBA cash rate net of its fee. So it's been a really good solution for investors looking to eke out a little bit higher return than, say, for example, a cash account earning RBA with daily liquidity. So you can use it, you can sell down those units and enter in the share market. So it's been a really good tool, and investors. It was one of the first Betashares funds that was really well supported by the market, and I think offered something really different at the time.
Yeah, it's something that, for disclosure, it's something that I hold in my portfolio because it does make a lot of sense to hold it if you're not earning enough interest from other things, and you can just buy and sell it like in any ETF and have your money back. So that's actually really, really handy. So we're going to kind of tweak this a little bit, and I'm going to try and make some comparisons between traditional types of bond ETFs and what you just described, which is AAA, which I kind of liken as a cash ETF.
Yeah.
Recently, Betashares have come out with 3 new ETFs, right? You guys have got, and these I'm going to go slow with them. The ticker symbols are 28BB, 29BB, and 30BB, right? So let's start with those.
Yeah.
Why are the ticker symbols like that? And maybe it helps to explain what they are at a high level as you go through.
Yeah, and maybe I should, unfortunately, I talked about AAA, but maybe I should talk about a traditional
yes, let's do that.
Bond ETF. So there are a range of different types of bond ETFs, but if we think about what would be known as a fixed rate bond ETF, that is an investment vehicle that will buy fixed rate bonds. And if you think about what an ETF is, it exists into perpetuity. So over its life, it'll be buying bonds, and bonds, like a loan, have a maturity date. As they reach towards maturity, the bond fund would typically sell those bonds down and buy new bonds that have a longer term. And that's why we sort of say that with a fund in perpetuity, we'll continue to buy new bonds.
So just like recycle, like
it's sort of recycling
sell one,
the
buy
capital.
one, sell one, buy one, and just keeps going.
That's right. That's right. And it will be somewhat beholden in terms of the returns to the yield environment that will change over time, because the bonds it's buying are basically issued in a different environment. So their coupons, which are the interest payments on a bond, will be different depending on where rates were at that time. So there's some variability there. There's a lot of good characteristics and good reasons to hold a bond ETF. But these new ETFs, which you described, we call them our defined income ETF. They're really designed around providing a more definitive income product. So, for example, the 28BB is the ticker code for the first one, which is the Betashares 2028 Fixed Term Corporate Bond Active ETF. And
quite a mouthful.
The others all follow. But the key really is in that fixed term. These are not like a traditional ETF, which runs to perpetuity. These are an ETF which has a maturity date. So that 28BB will mature in 2028. The purpose of the ETF is to buy a diversified portfolio of investment-grade, high-quality Australian bonds today, and then hold those bonds until their maturity. Now, where this gets really interesting is that there's some advantages to just holding a bond by itself. So if I basically hold a bond and the initial face value was $100, at maturity, provided that there isn't a default, I should expect to get my $100 back. And I know exactly what I get in terms of the coupons or the interest payments, which starts to sound a lot like a term deposit, don't you think? It's that certainty of what I've invested, what I'm going to get out at maturity, and the interest payments, or in this case, the distributions. The great thing about these funds is that they're holding that diversified portfolio of corporate bonds. There is some credit risk involved. These are very high quality Australian corporates. And in Australian corporate bonds, there's been a almost infinitesimally small amount of default risk. There's, I think, 1 or 2 issuers who have ever defaulted in investment grade bonds in Australia. Oh, wow. But provided we don't have one of those events, and that clearly can be a risk, then you should expect to receive the principal of the $100 back from holding that bond. And, an individual investor, it's very hard to buy bonds. Bonds often have face values of 100,000 or more. Yeah. Using this ETF and using the efficiency of investing through someone like Betashares, who can access this market and gets really tight pricing, we can create a diversified portfolio of bonds maturing at the same time to give certainty in terms of if I put my money in today, I know what I'm going to get at maturity, and I know, what those interest payments are going to be, monthly interest payments, or in this case, we would actually call them the fund distributions every month. And so I think that sort of ability to know what cash flows you're getting, ability to know what you're going to get at the end is really important. And if you're planning as a investor or an individual, if you have particular goals, you need to save money for a house or for retirement, you know that this is the particular series for you if you want that cash in 2028. Or if you have a longer time horizon, you can obviously look at the 29 BB or the 30 BB. So we can think of the use case as similar to a term deposit. We should note, obviously, that these are corporate bonds. A bank account, like a term deposit, does come with a government guarantee. So there is additional security with a term deposit that you do not get with these ETFs. But the basket of bonds are, very high quality. The average credit quality is on two of them is A and the other one A+. And the yield pickup or the extra interest that you should expect, is reasonable compensation for that risk.
Yeah.
So we sort of say net of fee, the 28 BB is yielding net of fee around about sort of 4.2%, which, compared to, I think I referenced earlier, if you're only getting 3% in a cash product, that's quite a pickup. And so for some investors, that'll really be, a meaningful difference in terms of, their cash flow needs.
So this brings in a question then. So because of the nature of these all maturing at the same time, and we said at the top of the show that interest rates on most term deposits now for 3 years are a lot lower than what people were probably used to.
Yeah.
Effectively, these, I would say, if I was like in the Betashares marketing team, but I would say that this is kind of like a really interesting, like a really compelling time to launch something like this, because you're saying, well, everyone else is going to be upset that their term deposits are now yielding less.
Yeah, that's right. In an environment where interest rates are falling, providing a product that gives you an elevated level of income, but also fixes that income for that period of whether you use the 28, the 29, or 30, that's a really powerful tool. And I think that investors that get in today, when if we do see rate cuts, they'll see that as a really important part of their portfolio in terms of generating the income that they may need for their lifestyle, or just in terms of helping their overall total returns of their portfolio.
So why would someone use this type of thing and not just like a standard bond ETF?
Well, I mean, standard bond ETF has a lot of good features and generally will give you really good income, but there are some things that will change over time. The distributions will change with yields over time, so you don't necessarily have the same certainty of income that you do with these funds. And over time, because this a standard bond ETF is buying and selling bonds, it won't necessarily always see what we call in bond markets the pull to par, where the bond, provided the issuer repays the bond, returns back to its original $100 face value. And that's part of the certainty here, is that if you are investing on day one, provided there isn't any defaults, you know exactly what you're going to get at the end. And that certainty, I think, is valuable for a lot of Australians.
So if someone was going to invest in something like this, is the suggestion therefore that if you invest in it for the income, it's designed that you would hold it until the end?
Yeah, so it's designed so you can hold it to the end, but you've got optionality, and that's where ETFs are really valuable. Now, if you held, for example, a term deposit, you could break a term deposit. Banks do allow that, but often it's a clunky process. There are fees attached, and if, for example, interest rates do fall, you don't necessarily get a benefit.
Yep.
Now, with these funds, what we will see is if rates fall by more than what's expected, that will typically be slightly reflected in the price, and you might actually be able to exit out of one of these products, one of these ETFs, with a slight gain. I'm not suggesting that that's why you would invest, but it's the ability to get the market value for when markets move in a favorable direction, which you'll get through these ETFs. If you were trying to exit out of the product before maturity, is another added benefit, which doesn't exist necessarily with other products.
Okay, so most people will be familiar with an ETF just living on. Like they sell it, it lives on. What happens at the end of the maturity date?
This one dies. Yeah, so that's quite unusual for an ETF, isn't it?
Yeah.
So investors will have the opportunity to roll into a new fixed term bond ETF. There will be a new one issued at the maturity, and there'll be a form sent out at maturity 2 months before, and they can elect in. But perhaps all I wanted was to hold for that period, and that's the time frame when it was appropriate. So obviously they're traded on market. I can elect to trade in and out into other series, and we will continue to issue series.
So there might be like 31 BB.
That's right. That's right. So in a year's time, so you have it as a series, allows people the choice, and allows them to move from one to another as their investment needs change.
Yeah, that makes a lot of sense. Okay, cool. Well, so there was a couple of things that I just wanted to touch off briefly. Let's say someone's got like a US shares ETF, so just like a standard US shares ETF.
Is it currency hedged?
We've talked enough about currency hedging today, Cameron. Where would something that's just like one of these, where would it fit in the mix? This is defensive, certainty? Is that what I'm thinking?
Yeah. So I mean, if you think about your assets, if you say you had 30% allocated to defensives, it would sit certainly in that position there. It's a really good tool in terms of providing that liquidity. It's I think relatively high credit quality. As I said before, doesn't come with a government guarantee that bank accounts do, but that yield pickup is for some people a really nice trade-off in terms of something which is really high quality, very diversified, and a really good level of yield. Certainly defensive. US equities tend to be certainly in the growth part of your portfolio. So there's diversification there.
I think I've got two final questions for you, but I'll put links in the show notes. I think that people would be really interested in this right now, needless to say, at least even people like myself, to be honest. So I'm going to ask you two final questions, which will probably round out this for people. If I asked you to stare into your crystal ball, or you could ask someone else in the office who has their finger on the pulse for these things, do you think interest rates will fall? Like we're recording this early May 2025. Do you think interest rates will fall within the next 12 months?
Yes. Yeah. So look, I mean, just looking at the data. So the RBA expected that in the June quarter, that the trim mean CPI would be within their target band. So the RBA says, if inflation is between 2% and 3%, that's pretty good.
Yep.
Now, it's already within that band in the March quarter. So we're already ahead of schedule versus what they might expect. So we're recording early May. Like I would tend to agree, and our chief economist expects a rate cut in May. We'll see if that's right by the time this goes to air. But we expect more rate cuts throughout this year.
Okay.
I think that the RBA's done a really good job, and the really fortunate thing for Australia is the tariff impacts are not going to impact us to the same degree as potentially they might hurt the states.
Yep.
And that really does open the way for the RBA to, if there is any fears as to what might happen to economic growth or employment, they're able to sort of take their foot off the handbrake by cutting rates and providing some accommodation for the Australian economy in what might be a relatively turbulent time in terms of global trade and the economy.
Good news then for people with a mortgage like myself. Not so good for people that are actively looking for income unless they're willing to explore different things, right? If they're just rolling over term deposits because that's all they know, there might not be as much yield to pick up, but maybe if they explored other options, there would be. Final question. Is it still possible to get 5% from a diversified portfolio in income? If I'm sitting back and thinking, I want just 5%, that would keep me happy. I've got a diversified portfolio. Do you think that that's reasonable?
It is. It is. So a lot of investors who hold direct hybrids are asking us that question right now. We run two hybrid funds. One is HBRD, which is an actively managed fund that holds not just hybrids, but other bank capital securities. And we also run BHYB, which is an index tracking Big Four bank hybrid fund. And they're both earning well over 5%. And really the question is there's a trade-off there in terms of how much risk are you willing to take? These defined income ETFs their yield is lower than that, but the credit quality is extremely high, and we expect it to be very capital stable. Hybrids do come with a slightly more elevated level of volatility. And then there's all sorts of other bond exposures and fixed income products that you can look at in between. So within investment grade, high quality Australian corporate credit, as we call it, there are solutions depending on your particular target and your appetite for risk that will help solve that challenge of how to generate income in a falling rate environment.
Okay, that's good news for people that do want to explore other options. Well, Cameron, this has been heaps of fun. In the time we've been talking, the sun's starting to set behind you. I can see it there, and it's looking great. These new funds are out now, and I'll put a link in the show notes to them. There's all the information available on the website. I've got it here. You can access the PDS. You can see all the literature. So, mate, always a pleasure to chat to you. Thanks for taking the time.
Thank you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.